Vinay Paharia is joining us now to talk about investing approach and how he is observing the market and running their schemes. Vinay, good afternoon. Thank you so much for your time. Let's start by getting your view before I talk to your schemes and overall on the quality of stocks which have been running in the last 6 months. Surely mid-cap and the mid-cap and small caps have started outperforming large cap, but you have analyzed the quality of companies also within that basket, purely given on the fundamentals. Out of all the huge number of data which you analyze, what are your observations? Should investors be wary of being active in that space?
Sure. Thank you, Ajay, for having me on the show, and warm good afternoon to everyone on the show. So, Ajay, as you rightly pointed out, we have tried to do a study of all the good quality companies within the BSE 500 index to see whether the popular adage that good quality companies do well over a period of time, is it passing the litmus test or not? So what has been the factual outcome? So what we have observed is that over a 3-year, 5-year, 10-year periods, good quality companies have consistently delivered superior returns compared to poorer quality companies. However, what is important to observe is that in the last fiscal year, that is year ended March 2021, each and every quarter in that year, we have seen that poorer companies have delivered a superior return compared to good quality companies. And as a result, we have seen a meaningful underperformance for good companies in the previous fiscal year. And hence, that is a very important finding out of our recent study.
Right. Also, we are almost winding up the earnings season, and you must have analyzed your own portfolio companies' earnings potential and the for the third quarter. Generally, it seems like a buoyant mood and the commentary coming out versus the valuations of the basket you're holding. And overall market too, do you get incremental comfort in topping up your holdings or even venturing, buying new? Fundamentals versus prices, what are your thoughts there?
Yeah, so first on the corporate results front, compared to what we thought a year back, we have been very positively surprised by what India Inc. has done. What we have clearly seen is that across a different set of sectors, companies have clearly tightened their belts. They have reduced their fixed costs, and they have been quite indiscriminate in doing that. And at the same point of time, the decline in gross profit was not as much as we had earlier thought. And importantly, as we go forward into the future, we will see a substantial improvement in gross profits. And with this lower fixed cost base, we think that there could be a meaningful benefit of operating leverage coming in for India Incorporated. And that could be sort of a positive surprise, which even we are not yet building in our numbers. Coming to the second part of your questions on price versus value, which we are seeing in the market. Yes, market today is trading at a premium to its current fair value. And that's the reason we are being a little bit more cautious in the market when we are approaching the near term. But when we look at a longer term horizon for equities, let's say over a 3-year and 5-year period, we clearly see that the fair value growth is going to be robust. And even if we assume a compression in price to value, we would see a reasonably healthy return outcome for investors if they are willing to invest with a 3 to 5 year time horizon. So we are quite optimistic for medium to long term returns for equities, but are approaching the near term with caution.
Right. Vinay, you're also somebody who observes the global macro also very closely. Increasingly, on the one hand, in the immediate 6 to 12 months, people are cheering the possibility that global growth will be very strong, and Nifty's over 50% earnings actually are global. Is it good for India, emerging markets, etc., global growth to be strong. On the other hand, it also brings along the risks of tapering, shrinking of liquidity, global liquidity led by Fed. How do you analyze these two, parameters, like a bull and bear scenario which is happening?
Yeah. So I think one thing which all investors need to bear in mind is that equity is one of the longest duration asset they are buying. So this is a very important terminology, very familiar to bond investors, because bond investors deal in with duration day in day out. But equity investors, I've hardly seen them talking about it. But importantly, equities are the longest duration assets available in the market, and hence are most sensitive to changes in long-term interest rates. So if the long-term structural rates go up, led by developed world, we will definitely have an impact on equity. And for us, that is the number one risk which we observe for the markets going forward. So the risk is going to be meaningful for developed world equities, but we foresee that on a relative basis, Indian equities would have a lesser risk compared to their global counterparts, purely from the interest rate perspective. But nevertheless, that's a risk.
Sure. Let's look at your portfolios then. You have a good dose of corporate banks. In fact, one of the big corporate banks just did a OFS as well today. What are your thoughts on corporate banks in terms of the risks they face in the subsequent quarters because of COVID related? They will again be required to do provisionings and asset quality may come under pressure, versus they are the best beneficiaries of a rebound in growth also in the economy.
Right. So Ajay, the way we look at all the banks and companies in the financial services sector is that quality is of utmost importance. And when we are talking about quality, we mean quality of underwriting. So be it a corporate bank or a retail bank, the historical track record of underwriting performance is extremely important. We have chosen those banks where we think the potential for credit losses would be far lower compared to their counterparts, and we do not take meaningful calls on whether the cycle will turn good or bad. Our objective is to buy good quality businesses. Since we are talking about banks, we want to buy good quality underwriters of credit and hold them for a longer period of time. And we have a diversified mix of such banks.
Also, I see, Infosys is one of the key names and top names in several of your schemes. Some recent mid-cap IT names like Happiest Mind also figure. How are you looking at these two pockets of IT space, which benefited a whole lot because of COVID-related push and digitization, found their mojo back, but the valuation of the large cap top 3-4 ones, the mid cap and some of these new IPOs?
Yeah, so while I would not comment on the individual names which you mentioned, but generally for the IT sector, we have been quite positive on the sector, and it is our biggest overweight sector within our fund house. And the simple reason for that is that this is a sector which has seen the overall demand curve shift towards the right, which means the demand on a sustainable basis has increased, not just for FY21 or 22, but significantly into the future as well, because the companies which they are servicing are treating IT spend more from a survival perspective than purely as a customer acquisition or a customer retention tool. So I think that is what has changed. And that is why Indian IT companies which are at the forefront of this action are expected to see a material improvement in their business outlook. And I think that is what has changed the multiples also. Remember, the multiples are a function of earnings growth, returns on equity, and the interest rates. So I think since the earnings growth potential has gone up, then the multiples have also gone up, and different companies have different multiples. We'll not go in that, but generally for the sector, it's doing well.
Talking of multiples, You have a reasonable exposure to some mid-cap to large cap among the top 3 big ones, chemical companies. Now I want to understand from you some of these chemical companies, the universe of Aartis of the world, PIs, UPLs, all of that. I don't want a reaction on the names, but these are almost 30, 40, 50,000 crore companies now, and valuations also are not as cheap, upwards of 50 or around that median, between 40 to 50 times. The other pocket is $1 billion odd, 5 to 10,000 crore MCAP ones. How are you analyzing this entire basket and the opportunity it presents itself? Many of them are announcing good capex, good commentary as well on visibility, but valuations are no longer cheap. No reaction on stocks, but the space.
So I think, Ajay, one of the simplest ways to view any company and its valuation is to understand a simple equation, which is equities valuation. It's equity is simply a growing annuity to perpetuity. Higher the growth, higher would be the valuation. So I think the multiples are predominantly influenced by returns on equity and the accompanying earnings growth. Many of the chemical companies which you have highlighted, I think they have displayed strong growth because of certain uniqueness in their businesses. These are research-led businesses, not run-of-the-mill commodity companies. And we have been quite particular not looking at companies which have a commodity nature in their underlying business, which is that their end product prices have seen a surge because of temporary reasons, and these can come back, and hence the margins may shrink, so on and so forth. We have been quite particular in buying into companies which have a sustainable return on capital, which have a sustainable, strong growth profile, and which have something unique in those companies. So I think we have not basketed or bucketed all of these companies in one segment, but looked at each and every opportunity on a bottom-up basis, and only after strong conviction have we bought into them.
Right. Certainly, you have a good portfolio there. Vinay, always enjoy chatting with you. Thank you so much for your time today as well.
Thank you, Ajay. Nice being on the show. Bye-bye.
That was Vinay Paharia.